Welcome, guys. This is chapter 6 of managerial accounting. And we're going to continue talking about variable costing. Now, if during this lecture, this time together, if you have any questions at all, please stop me. If you can't hear me, if you can't see something, please let me know right away so we get it resolved instead of you guys sitting there in limbo. So variable costing is what we're talking about today, and we're going to talk about how it differs from the absorption costing method. This chapter uses actual costing rather than the normal costing approach that we used in job order costing. This chapter always uses the actual number of units produced as the allocation base for assigning actual fixed manufacturing overhead costs to products. And lastly, this chapter assumes that the variable manufacturing cost per unit and the total fixed manufacturing overhead cost per unit remain constant. So we know in dealing with absorption costing, we had direct materials, direct labor, variable manufacturing, and fixed manufacturing overhead as product cost. And then as period costs, we had variable selling and admin, fixed selling and admin. However, in variable costing, we are going to switch it up. The direct materials, direct labor, and variable manufacturing overhead will be used for product costs. And then for period costs, we've got the fixed manufacturing overhead, variable selling, and fixed selling. So basically what you see is the fixed manufacturing overhead in absorption costing is a product cost. In variable costing, it's going to be a period cost. Now, which method will produce the highest values for work in process and finished goods inventory? Well, it's going to be absorption costing because the fixed manufacturing overhead is part of product costs, not period costs. Guys, I'm sorry, I'm still sick. I'm getting better, but I'm sorry it's hard to hear me. Harvey Company produces a single product with the following information available. We have the number of units produced annually, and then we have variable cost per unit. We have our direct materials, direct labor, and variable manufacturing overhead of $10. And then we have our selling and administrative expenses of $3. And then we have our fixed cost. The manufacturing overhead is $150,000 and selling and admin is $100,000. Unit product cost is determined as follows. We have under absorption costing and under variable costing, the direct materials, direct labor, and variable manufacturing overhead is part of the product costing. Under absorption costing, the fixed manufacturing overhead is part of product cost, but not in variable costing. Under variable costing, only the variable production costs are included in product costs. Okay. Ida Company produces a handcrafted musical instrument called a gamelan that is similar to a xylophone. The gamelans are sold for $850. Selected data for the company's operations last year are shown. We show the units produced, the units sold, the ending inventory, and then we've got our variable costs. We've got our fixed costs. Assume the company uses absorption costing. Compute the unit product cost for one gamelan, and then we'll do the same using variable costing. So guys, we know the difference is under absorption costing. We take all manufacturing overhead and put it into the product cost. Under variable, we only take the variable manufacturing overhead to put into the product cost. So under absorption, direct materials, direct labor, variable, and fixed gives us a $700 product cost under absorption costing. The difference with variable costing will remove the fixed manufacturing overhead to show the cost is $460. Selling and admin are treated as period cost under both methods. Now, how do we go about preparing income statements using variable and absorption costing? Let's assume the following information for Harvey. 20,000 units were sold during the year at $30 each. There's no beginning inventory. We'll compute net operating income using absorption and variable costing. So here we have sales, which of course is going to be the same either way. Under variable costing, we have our variable cost of goods sold. We have our variable selling and administrative. And then our total variable expenses to come up with our contribution margin. Then we take all of our fixed cost to then come up with our net operating income. You see here, we only use variable manufacturing costs to show prior to the contribution margin. Under absorption costing, we'll take our sales, our cost of goods sold, our unit product cost, 20,000 at $16 is how much we've sold, the cost of those goods that were sold to come up with our gross margin. Then we have our selling and admin expenses to then come up with our net income. Okay. No, the 5,000 units that were still in finished goods stay with the products. So that's not going to reflect on the income statement until those products are sold. Refer to the data in exercise 6.1 for Ida Company. The absorption costing income, I hate when I have a mistake there. The absorption costing income statement prepared by the company's accountant is shown here. Under absorption costing, how much fixed manufacturing overhead cost is included in the company's inventory at the end of the year? Okay, so fixed manufacturing overhead cost deferred in inventory is the 25 units at $240 per unit. We take the 60,000 in costs, spread that over 250 units to come up with our 240 units. Under variable costing, we show our sales. We show our variable cost of goods sold. We show our variable selling and admin. Then we show our fixed manufacturing and fixed selling to get our net operating income. Under the variable costing, we only use the variable manufacturing overhead because the fixed manufacturing overhead goes into period costs. The difference in the net operating income between the variable and absorption is figured by deferring the fixed manufacturing overhead cost of inventory under the absorption. Note from part 1, $6,000 of fixed manufacturing overhead cost was put on the balance sheet in inventory. So know that income under absorption is going to be higher than under variable. Okay. Now we're going to look at the variable and the absorption costing and really understand how and why they differ. When we have absorption costing, we've got fixed manufacturing expenses that get broken into the cost of goods sold versus the ending inventory because they're a product cost. Whereas in variable costing, all of those are placed into period costs. So you see right away that 30,000 of fixed manufacturing expenses that are sitting in ending inventory under absorption costing are going to stay as an asset until those products are actually sold. Whereas in variable costing, they're a period expense. Does that make sense, guys? It's just different ways of representing income based on which approach we're using. We can reconcile the difference between absorption and variable by looking at our variable cost net operating income is 90,000. If we add the 30,000 that's sitting in ending inventory for absorption costing, we understand where we get our absorption costing, net operating income, and why they're off. Okay. So our fixed manufacturing overhead of the 150,000 divided by number of units that were produced ends up being $6 per unit. So we know what was produced, we know what was sold, we know what was sitting in the beginning inventory. This is year 2. At the end of year 1, we had 5,000 sitting in finished goods. Now, year 2, we manufactured 25,000, but we sold all 30. We have our sales price, our variable cost per unit, and then our fixed costs. So under absorption costing, our unit product cost is $16 per unit because we include the fixed manufacturing overhead. Under variable costing, we do not include the fixed manufacturing overhead. Since the variable cost per unit, the total fixed cost, and the number of units produced remain unchanged, the unit cost computations also remain unchanged. Now, under variable costing, we only take the variable cost of goods sold, and that's the $10, not the 16 under absorption. But all the fixed manufacturing overhead goes into the period cost. Okay. But under absorption, we take all costs related to product costs and expense them when we sell the product because they're part of product costs. So the $16 per unit includes the fixed manufacturing overhead. Okay. And remember that fixed manufacturing, that ending inventory at the end of year 1 is all being sold in year 2. How do we reconcile the differences? Again, when we take our variable costing, and in year 2, since we had that fixed manufacturing ending inventory of finished goods, those were sold. They were released from inventory. So the absorption costing would be $230,000 because we are finally expensing under cost of goods sold those items the year before that were sitting in finished goods. In period 1, under absorption, we had 120. Period 2, we had 230. Ultimately, guys, it's going to be over the total period the same amount. It's just accounting for them differently. between the periods. Now, relation between production and sales, and then relation between variable and absorption incomes and how it affects inventory. So, relation between production and sales. When units produced equal units sold, everything's the same, no issues. When units produced are greater than units sold, then absorption is going to be a greater net income than variable costing. Why? Because we produce more than we sold, which means we have costs sitting in finished goods. They didn't hit the income statement. So because they didn't hit the income statement, the net income under absorption is going to be higher. But remember, with variable costing, all those fixed manufacturing overhead, if we sold it or not, gets put into period cost. So that net income is going to be lower under variable. If the units produced are great or less than the units sold, then when inventory decreases, our absorption costing net income is going to be lower than the variable costing, because we are finally selling products that the previous year were sitting in finished goods. Now that they're out, they're being sold in addition to what we produced this period. Absorption is going to result in a lower net income than variable costing will. Variable costing categorizes cost as variable and fixed, so it's easier to use this income statement for CVP analysis. Because absorption costing assigns fixed manufacturing costs to units produced, a portion of fixed manufacturing overhead is still in inventory when those units are unsold. The potential result is positive operating income when the number of units sold is less than the break-even point. Variable costing income is only affected by changes in unit sales. It is not affected by the number of units produced. As a general rule, when sales go up, net operating income goes up, and vice versa. Absorption costing income is influenced by changes in unit sales and units of production. Net operating income can be increased simply by producing more units, even if those units are not sold. Variable costing correctly identifies the additional variable cost that are incurred to make one more unit. It emphasizes the impact of total fixed cost on profits. Since Absorption costing assigns fixed manufacturing overhead costs to units produced. It gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced, even though it's not. Therefore, the result can be inappropriate pricing decisions and product discontinuation decisions. Okay. Okay. Jorgensen Lighting manufactures heavy-duty street lighting systems for municipalities. The company uses variable costing for internal management reports and absorption costing for external reports to shareholders, creditors, and the government. The company has provided the following data. The company's fixed manufacturing overhead per unit was constant at $560 for all 3 years. So we see beginning units, ending units, and then the variable costing, net operating income, each one. Calculate each year's absorption costing, net operating income. Present your answer in the form of a reconciliation report. Assume in year 4 that the company's variable costing, net operating income, was $984,400, and its absorption costing, net operating income, was $1,012,400. Did inventories increase or decrease during year 4? And how much fixed manufacturing overhead cost was deferred or released from inventory during year 4? So we're going to, based on this, look at the absorption costing net income. So if we know our beginning inventory and we know our ending inventory, we can see the change in inventory, okay, for each year. Our fixed manufacturing overhead in ending inventory is sitting at $560 per unit. So we know our ending inventory, that's going into our balance sheet. Our fixed manufacturing overhead in beginning inventory, and then the difference. So in the case of year 1, we know that we sold more than what we manufactured. Okay, so since we sold more than what we manufactured, our absorption costing is going to be a lower income. And what we would do is subtract out the fixed manufacturing overhead that got released from inventory. Is going to reduce that net income because it's now part of cost of goods sold. In year 2, we we sold less than what we produced. Since we sold less than what we produced, then under absorption costing, we will add that amount of fixed manufacturing overhead that is still sitting in ending inventory. Okay. Then in year 3, excuse me. Then in year 3, we sold more than we produced. So again, in this scenario, excuse me, we sold less than we produced. So we will show what's sitting in ending inventory. And under variable costing, that got included in the income statement, the fixed manufacturing overhead. But we know for absorption costing, that is sitting in the balance sheet. Okay. What this is supposed to help you understand is how you reconcile the difference in net income using the variable costing method versus the absorption costing method. Now, assume in year 4 that the company's variable costing net operating income is $984,000 and its absorption costing net operating income is $1,012,400. Did inventories increase or decrease in year 4? Well, we know that the inventories had to decrease, increase in year 4 because absorption costing, the net income, is higher, which means more is sitting in ending inventory because absorption costing net operating income was greater. Inventories had to increase. Fixed manufacturing overhead was put into ending inventory, not on the income statement. Okay. Next, we'll prepare a segmented income statement that differentiates traceable fixed cost from common fixed costs. Segment income reporting is a department or any type of activity or part of an organization where they want to break it down. You can have a store, a territory, a service center. In order to build these, we'll separate the fixed from the variable cost using a contribution format. We need to identify those traceable fixed costs. Traceable fixed costs arise because the existence of a particular segment would disappear over time if the segment disappears. Examples could include the salary of the Fritos product manager at Pepsi, because it's a cost of the Fritos division. The maintenance cost, the building in which Boeing 747s are assembled, is a traceable fixed cost of the 747 department of Boeing. Common fixed costs arise because of the overall operation of the company. And they wouldn't disappear if a particular segment got eliminated. The salary of CEO is the salary of CEO. And if they eliminate a division, still going to have him. The cost of heating a Safeway or a grocery store is a common fixed cost. And it doesn't matter various departments. That cost is going to happen anyway. It's important to know the traceable fixed cost of one segment could be a common fixed cost of another segment. So the landing fee paid to land an airplane at an airport is traceable to that flight. But it's not necessarily traceable to business class or economy class or first class. It's traceable to that flight, though. The segment margin, which is computed by subtracting the traceable fixed cost of a segment from its contribution margin, is the best gauge in the long run profitability of a segment. Okay. Weber has two divisions, the computer division and the television division. Let's look at the television division income statement. So the television division shows our sales. We see our variable cost of goods sold and our other variable costs to come up with our contribution margin. Then we take our fixed expenses that we can trace to this division to then come up with our division net income. We use the contribution margin by taking sales less variable costs. Okay. Now, excuse me, we've got the whole company, and then we have the divisions broken out. There are common fixed expenses that really shouldn't be allotted to these various divisions. These expenses are going to remain even if they eliminate a division. Therefore, they shouldn't allocate those to each of the individual divisions. Fixed expenses that are traceable to one segment can become common fixed expenses if the company gets divided into smaller segments. Weber has two kinds of TVs, regular and big screen. We see the sales of regular, the sales of big screen. So we see the product line margin for regular, the product line margin for big screen. When we look at the fixed costs that are traced directly to the television division, 80,000 can be traced to regular or big screen, but 10 can't be traced. They're going to happen either way. So we don't add those to the various division segmented statements. Once a company prepares a contribution format segmented income statement, it can use the statement to make decisions and perform break-even analysis. So in this case, you see, if we increase our sales by 5%, and let's say it's because we have 5,000 in additional advertising, what happens? Well, you see here, as a result of an increase in sales, we see our contribution margin increases, $52.50 in the regular screens, $22.50 in the big screens. And as a result, you see the difference, in the margin per product line. Now, our common expense is going to increase, and the division margin increases by $2,500. And then you see the breakdown by each screen. Royal Lawn Care Company produces and sells 2 packaged products, Weed Ban and Green Grow. Revenue and cost information related to the products are below. Last year, the company produced and sold 15,000 units of Weed Ban and 28,000 units of Green Grow. Its annual common fixed expenses are $22,000. So we see the selling price, variable expenses, and the traceable fixed expenses. And we see how much was sold of each. So to prepare a contribution income statement, we separate out 15,000 units. Let me just see here. At $6 a unit, sales price is 90,000. Green Grow, 28,000 units at $750, it's $210. Then we show our variable expenses, and then our contribution margin. We have the traceable fixed expenses. Then we've got the common expenses that aren't traceable to either of those segments to show our net operating income. Does this make sense? I hope so.
Yep.
Good.
Yeah.
Yes.
Thank you, guys. Now, we're going to look at break-even points when we can trace fixed costs. So here we've got our income statement with our 2 divisions, television and computer. And we see Excuse me one sec. So it became, excuse me, division margin was at 100,000 less the common expenses. Show the net operating income is sitting at 75,000. Now, how do we calculate the break-even point? The company-wide break-even point is computed, but by dividing the sum of the company's traceable fixed expenses and common fixed expenses by the company's overall contribution margin ratio. So if you take the 170,000 plus the 25,000, 170 plus the 25, divide that by the contribution margin ratio, 270 divided by 500, you come up with 0.54. You take the break-even point, so you take the 170 and the 25, divide that by the break-even contribution ratio to get 361, 111. So then to calculate the break-even point for each business segment, we'll take the break-even, the fixed expense, divide that by the contribution margin ratio for it to be 180. For computer, the fixed expense divided by the contribution margin ratio, 133, 333. The 25,000 of company-wide common fixed expenses are excluded from the segment break-even calculations because the common fixed expenses aren't traceable to segments and are not influenced by segment level decisions. Costs assigned to a segment should include all costs attributable to that segment from the company's value chain. The research and development, product design, manufacturing and marketing and distribution, and customer service. Costs that can be traced directly to specific segments of a company should not be allocated to other segments. Some companies allocate costs to segments using arbitrary basis. Costs should be allocated to segments only when the allocation base actually drives the cost being allocated. This practice makes a profitable business segment look unprofitable, and it makes managers accountable for things they can't even control. So here Hoagland's Lakeshore prepares its income statement, broken down into bar and restaurant. How much of the common fixed expense of 200,000 can be avoided by eliminating the bar? None. Remember, common fixed expenses are going to occur no matter what. Suppose square feet is used for the basis of allocating the common fixed expense of 200,000. How much would be allocated to the bar if the bar occupies 1,000 square feet and the restaurant occupies 9,000 square feet? 10%. If Hoagland's allocates its common fixed expenses to the bar and the restaurant, what would be the reported profit of each segment? The bar would be in the hole. But should the bar be eliminated? No. The bar is profiting. So if you go and take those common costs and then make that into your decision why you reduce the bar, it's not a wise choice. Those costs are gonna be incurred no matter what. Why reduce the bar? Both GAAP and IFRS requires absorption costing for external reports. Because of that, most companies use it for also their internal reports. But this is trying to help you understand the benefits of variable reporting. Under absorption costing, fixed manufacturing costs are assigned to products. Under variable costing, fixed manufacturing cost are capacity cost and will be incurred even if nothing is being produced. GAAP and IFRS require traded companies, publicly traded companies, to include segmented financial data in their annual reports. Companies must report segmented results to shareholders using the same methods that are used for internal segmented reports. This requirement motivates managers to not use the contribution approach because they don't want to share this stuff with the public. Okay, so here let's look at exercise 6.4. Okay. Piedmont segments its business into two regions, North and South. The company prepared the contribution format segmented income statement shown here. Compute the company-wide break-even point in dollar sales. Then we'll do the break-even for the North region and the South region. Okay. So we take 120,000 fixed plus the 50,000 common. It's 170. We divide that by the 240 contribution margin divided by the sales gives us break even of 425,000. For the North region, we take the fixed divided by the ratio. That would be 200,000. South, break even is 100,000. Ranner, Harris, and Chan is a consulting firm that specializes in information systems for medical and dental clinics. The firm has 2 offices, one in Chicago and one in Minneapolis. The firm classifies the direct cost of consulting jobs as variable costs. A contribution format segmented income statement recently is shown of sales and then the breakdown. And we've got our traceable fixed and common. Compute the company-wide break-even point in dollar sales, then compute them per office. So you see, the company-wide break-even is 378,000. The Chicago office is 111,429. They're traceable divided by their contribution margin. Minneapolis, they're traceable by their contribution margin. The sum of the segment break even is less than the company-wide break even because the company-wide takes into account common fixed expenses that do not affect the segment break-even analysis. By how much would the company's net operating income increase if Minneapolis increased its sales by 75,000 per year? Well, if you look at the contribution margin ratio, 30,000 would be increased contribution margin. Since they say their fixed cost won't change, that entire 30,000 will be an increase to net operating income. It's not correct to multiply the 75,000 increase by just the Minneapolis segment. This approach assumes that the segment's traceable fixed expenses are going to increase in proportion to sales. So if you're making a decision to say, hey, here's the increase in the Minneapolis division, you'll use the overall contribution margin ratio, not just that locale. Now, assume that the sales in Chicago increase by 50,000 next year and that sales in Minneapolis don't change. Then prepare a new segmented income statement. Observe from the income statement that you prepared that the contribution margin ratio for Chicago has remained unchanged, but that the segment margin ratio has changed. Why? So, as you see here, we've got our new numbers showing an increase in Chicago. The segment margin ratio rises and falls as sales rise and fall due to the presence of fixed cost. The fixed costs are spread over a larger base as sales increase. In contrast to the segment ratio, the contribution margin ratio for a given segment will stay stable so long there's no change in either the variable expenses or the selling price per unit of service. So this week, it's really a lot of understanding the reporting of these variable costing methods. Any questions on your homework before we move on? Let me go here and look. For chapter 6, excuse me. So for this, break-even point, compute the unit product costs. Guys, everything you're going to have, we've had exercises just like this on the slides this week. Should be good on that one. Using variable costing, what's the unit product cost? What's the operating income? And then reconcile the absorption to variable costing. Same. Prepare that contribution segmented income statement. Preparing costs, product costs under both methods. And reconciling the numbers. Same thing. Guys, if you need help with any of these questions, feel free to email me and I can help get you on the right path. Okay? Have a great week. Any questions before we leave? Well, guys, you take care.
Thank you. You too.
Thank you.
Bye-bye.